A fairly quiet week for the physical gold market last week, with a lack of any real direction in the gold price, keeping most Southeast Asian markets largely soundless. But crucially, the Indian market has at last shown some signs of reopening. Protesters there returned to work 1 week prior to the reopening of Parliament on April 24th. Last week, around 70 to 80% of jewellers restarted operations during what's traditionally an auspicious period for the purchase of luxury items, and as we understand it, all of the market should have restarted today. Those on strike have increasingly come to accept that the government will not reverse its decision to introduce a 1% excise duty on all jewellery sales. Instead, the protesters there have submitted several proposals to the government in response to the tax aimed at lessening the blow of the imposition of the duty, and as we understand it, most of those proposals have been accepted, although the last contentious points will need to wait until Parliament reopens on Sunday until they can be decided. Again, as we understand it, on April 24th, the jewellers should meet again to decide whether a full strike will continue or whether to call it off officially. Interestingly, while the strike was nominally in protest against the imposition of the duty, the jewellers' biggest issue is the auditing that comes with it and the fact that excise duties can simply enter a property and arrest or close down a business should they find any discrepancies. So, as a result, the discount on 99.5% purity kilobars has shrunk dramatically to around $7 to $10 from the $15 to $25 level that we've seen over the last month. Still, from a wholesale perspective, domestic inventories that were accumulated at the lower tax rate continue to be drawn down. Once this stock has been run down, the middle of next week, sources believe, many of the country's bullion dealers will once again be able to provide a more competitive trade. In Shanghai, the premium for 49 kilobars ended last week around the $2 mark. In quiet trading conditions, physical demand there is still generally quite weak overall. Buying interest is much thinner than it was prior to the new year, and investment demand seems not to be as strong as it was. Investors in China for gold-backed ETFs are simply looking elsewhere at the moment. Still, there are signs that business in the gold leasing market between Chinese banks and companies in the bullion industry is once again picking up, others have noted, which should be of significance as the month progresses, particularly in a week where the new Shanghai gold benchmark is set to launch on Tuesday. In Southeast Asia, things are a little more mixed. In Hong Kong, most 49 kilobars are now trading between flat and a discount of about $1 to international prices, reflecting the current high level of inventories in the region. In Singapore, liquidity is also dried up in response to the uninspired prices. Dealers are quoting premiums of up to 50 cents, however, on some fresh bars, although customers are understandably referencing discounts in nearby Hong Kong. Similar story in most other markets in Tokyo, despite media reports of relatively larger volumes in the Japanese domestic market over the last few weeks. Discounts in the region remain at up to $1 on the physical market and similarly on the locally gold-backed ETFs. Finally, in the Middle East, discounts have deepened as demand continues to fail to keep up with supply. In Dubai, a build-up of non-LBMA material has seen most locally produced kilobars trading at discounts of up to $1.50 on the ounce. With the Indian market effectively closed for March, some material originally intended for India had been redirected to the Emirates. The story in Turkey is largely similar, with bars available with discounts of up to $1. Supply is plentiful and demand in the face of continued economic and political uncertainty is understandably weaker. The Turkish lira in particular remains considerably soft against the dollar, causing the local gold price to remain much higher. This is Ian Walker reporting for FastMarkets in London.